This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 489 was produced on July 17th, 2025. I'm Eric Townsend. 42 Macro founder Darius Dale returns as this week's feature interview guest, and echoing many of the same sentiments Lynn Alden shared with us last week, Darius is bullish U.S. equities. But he says the reason stocks will perform well over the next year is that we've just transitioned to a new fiscal policy objective of growing our way out of our staggering U.S. national debt. And that can only mean pro-growth stimulative policies that are bullish U.S. equities. But Darius says there are storm clouds on the distant horizon because growing your way out of debt usually doesn't work. And when it doesn't, the next move will usually be to try and print your way out of debt. And when we get to that chapter of the story that Darius sees unfolding over the next few years, you're going to want to have already taken profits.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, July 16th, 2025. The S&P 500 index flat week over week, trading at 62.63. Markets are in a holding pattern into the OPEX week. We'll take a closer look at that chart and the key technical levels to watch in the Postgame segment. The US dollar index up 83 basis points, trading at 98.28. Strengthening off its worst levels, leaving the question as if the US dollar is now putting in its weakening back to the bottom of its multi-week range. The August RBOB gasoline down 411 basis points, trading at 210. The August gold contract trading up 114 basis points, trading at 33.59, still consolidating in the middle of its multi-month range. The September copper contract up 73 basis points, trading at 552. Uranium down 14 basis points, trading at 72.05. And the U.S. 10-year Treasury yield up 13 basis points, trading at 4.48. The key news to watch next week is the Fed Chair Powell speaking, the European and U.S. flash manufacturing and services PMIs, and the ECB monetary policy statement. This week's feature interview guest is 42 Macro founder Darius Dale. Eric and Darius discuss structural forces, market dynamics, Fed policy, and concerns about the exogenous risks. Eric's interview with Darius Dale is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is 42 Macro founder Darius Dale. As always, Darius has prepared a fantastic slide deck to accompany today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not registered yet at MacroVoices.com. Just go to the homepage, MacroVoices.com, look for the red button above Darius's picture that says looking for the downloads. Darius, it's great to get you back on the show. It's been way too long. I want to start with the market outlook and just what's going on. So many people are really saying this has gone too far. I don't know if you caught Lynn Alden last week saying, run your portfolio hot. I think you're more in Lynn's camp. Give us the outlook on what's going on with the market. Where do we stand?
Yeah, I appreciate you having me back on, man. I'm really grateful. And anytime I can be in the same camp as someone as brilliant as Lynn Alden, that's always a good sign. I have a tremendous amount of respect for her. And I agree. You know, we've been pounding the table on our paradigm C view since late April, early May, specifically early May, in terms of how resoundingly bullish we've been on risk assets. And we continue to see a tremendous amount of structural upside over the long term as a function of our paradigm C theme. Just kind of really quickly highlighting a chart that can sort of explain why both Lynn and I think the economy is being ran hot. If you go to slide 44 in our slide deck, and by the way, we have our usual customary slide deck for you guys as well. So listeners will be able to access that if they sign up for your Research Roundup email. Anyway, getting back into slide 44, where we show in this chart are a collection of major economies through the lens of their sovereign fiscal balance to GDP ratio, their current account balance to GDP ratio, and then we sum those figures to come up with a twin balance. So if you look at the U.S., which are the blue, the dark blue lines in each panel, the U.S. is running a record non-war, non-recession budget deficit, and has been for an extended period of time, really throughout the Biden administration, in terms of this lurching forward into fiscal dominance that really began back in 2020 with COVID. We essentially stayed there since. Part of that's been a driver of our current account deficit, really swelling minus 4.6% of GDP. And so now the U.S. is sort of running these persistent twin deficits somewhere in the 11 to 12% range. And in the 11 to 12% range, we are on par with an economy like Brazil or Argentina or Turkey. These are types of economies that you tend to see dramatic currency declines, dramatic asset price appreciation, and ultimately a tremendous amount of political unrest, if you will, as a function of the income and wealth inequality that tends to perpetuate.
Well, Darius, I have a strong feeling that both you and Lynn are right, and that concerns me, oddly enough, because that's not where I'm positioned. I'm actually probably more hedged with more bearish exposure on than I've had in years. And the reason I'd like to run past you, because I think you and Lynn both have the macro call right here. What I see is an exogenous risk, and I wish I knew a more efficient way to hedge it. But I think it's been proven now that President Trump and Secretary Bessent are not concerned about collateral damage in financial markets. And one of the signals that I thought was particularly important was the way that they just whipsawed copper up and down. We might, tariff copper's up 50% almost on speculation front running. Oh, we're not going to tariff copper because it's a source material that we need to support American business. We would never tariff copper. Crash, probably the biggest down day in copper in years. Then we're through the roof on the 50% copper tariff, which is diametrically opposed to what Trump was saying a month earlier. So it seems to me that they have really big policy initiatives that they're intending. They're not done yet, and they're not afraid to break things along the way. Now, I suppose there's just as many right tail risks as there are left tail risks in that, right? But the ones that I have to hedge against because of where my other risk exposure is the left tail risks. So for that reason, I'm way overhedged, and maybe I shouldn't be. What do you think?
Well, that's a great question, Eric. And I will say is I think if you take a short to medium term time horizon, which is sort of 1 to 3 months in our risk management nomenclature, I think you're sort of appropriate to be at least somewhat hedged, because it's very likely that we see the Section 232 tariffs, which have somewhat been forgotten about by market participants, as well as the increased aggression by the Trump administration with respect to trade policy negotiations. Those things are likely to get worse over that time horizon. And so it's very likely you see at the bare minimum, a 5 to 8% pullback, let's say in the S&P. You can extrapolate what that means for other asset classes on a beta adjusted basis. But from our perspective, when you take a look into the medium to long term, that's a time horizon of 3 to 12 plus months in our risk management nomenclature, we think Paradigm C is here to stay and is likely to result in dramatic upside for risk assets and also the economy as well. Essentially what we're arguing for is that, hey, even though there are these tenets of policy like tariffs, trade, the general kind of chaotic nature with which the administration is negotiating trade policy, even though there's a tremendous amount of policy uncertainty stemming from that, we would argue that policy uncertainty is going to be resolved on a net positive basis. Net positive for growth, net positive for asset markets, and ultimately net positive for investors that are participating in our Paradigm C theme. So one final thing I'll say on this is I hear you on the administration's boldness with regards to it seems like they're increasingly less willing to respond to markets and market signals in terms of their aggressive they are being on trade policy. However, I would say the biggest pivot came back on April 9th, if you recall, when President Trump punted on the Liberation Day tariffs. And if you go to slide 43 tells you exactly why they punted and why why we're likely to remain in this Paradigm C framework for an extended period of time. We're talking at least through the November 2026 midterms, and perhaps even longer than that if the Republicans win. So on this chart on slide 43, we show the U.S.'s net international investment position. As you can see, we're at a $26 trillion deficit, which has more than doubled in the past 5 years. And so now the U.S.'s net international investment deficit to GDP ratio is somewhere on the order of 90%, and it's a fourth of global GDP. And so what that essentially means is that the U.S. economy has sort of Hoover vacuumed a tremendous amount of the world's capital over the past, let's call it 15 years, with a tremendous amount of that coming in the last 5 years. And as a function of that, if you skip ahead to slide 40, 45, and 46, on slide 45, we show the average 10-year nominal yield and MSCI equity index earnings yield to give you an indication of what the relative cost of capital is for these economies. And as you can see, the U.S., with its twin deficit ratio of about 12% and its net international investment to GDP ratio of about 90%, which is about a fourth of global GDP, is capitalizing itself as if it were a creditor economy, a net international investment surplus creditor economy. We're down there at kind of around 4%, which is right in line with Japan, which is one of the world's largest surplus economies. It's actually below Eurozone and China, which are the two of the three largest surplus net international investment surplus economies. And so what we saw throughout March and especially throughout early April, in our opinion, forced the administration to transition from what we were calling paradigm B, which is a dramatic fiscal retrenchment, which would ultimately narrow the current account surplus or narrow the current account deficit and ultimately take us into a new paradigm, a much less inflationary paradigm. And they pivoted to paradigm C because they were ultimately concerned about the persistence of the Cerro America trade, which was shown on slide 46. Those persistent capital outflows that we saw, remember we saw several indications of stocks down, dollar down, the bonds down, which has never really happened. It's seldom happened in anyone's career in this industry. We saw several indications of that. And what that was a signal to both us and the administration was that, this sort of hard line approach to policymaking in terms of transitioning from paradigm A, which is Biden's economy, to what would have been paradigm B, was actually contributing to an elevated risk of a durable loss of U.S. exceptionalism, which in our view would have contributed to a debt spiral. In this chart, we show federal interest payments to GDP. We're up at 4% now. That's a 3 sigma move relative to the trailing 25 years. And ultimately, we're headed back towards potentially all-time highs of this ratio, partially as a function of higher interest rates, but also obviously as a function of the increase in the deficits that we've seen in this fiscal dominance regime. And so if they were going to go full bore into it, the risk of going full bore into it, which we saw on the tape several times throughout April, was a durable loss of U.S. exceptionalism and this debt spiral risk. And you don't want to get into a debt spiral because it's incredibly hard to get out. So in our view, we think we're very insulated as investors from that outcome, that more bearish outcome that was paradigm B, and why we think they pivoted to paradigm C on April 9th.
Paradigm Charlie. What is it?
Let me take you through it. So if you go to slide 22, where we show labor share of national income and capital share of national income, to me, this has always been one of the most important charts in macro and has been for over a decade now. This chart shows the increasing share of income that is essentially being siphoned away from household balance sheets to corporate balance sheets as a function of a variety of policies, but I would say globalization, the disparate taxation of labor versus capital income, or these are all types of structural forces that have contributed to this, kind of very awkward dichotomy, if you will. So at 52% labor share of national income, we're down about 500 basis points from the long run mean prior to 2000. That represents an annual transfer of about $1.5 trillion from U.S. workers to U.S. asset owners, which is roughly about a 15% annual loss of income for the median U.S. household. And so what ultimately the output of that is, if you look at slide 24, that dynamic sort of contributed to this very K-shaped U.S. economy that we're now all living in and all participating in from a political volatility perspective. So this chart on slide 24, we show various quintiles, the 5 quintiles share of household income. And as you can see, unless you're in the top 20% from a household income perspective, you lost income on a relative basis to that upper cohort of households over the past, let's call it 40, 50 years, partially as a function of everything we talked about on slide 22. So in our view, we think President Trump was elected to fix this. If you go to slide 36, where we show the Electoral College map spanning with red from sea to shining sea, to us last fall, that was a pretty clear indication that, hey, consumers and businesses on the bottom part of that K, they don't appreciate the crippling income and wealth inequality. They did not appreciate the 40-year high in inflation that was engineered by the fiscal largesse and monetary largesse of the Biden administration. And ultimately, they didn't appreciate the historic crowding out of those medium to bottom and medium households and small to medium-sized enterprises. That was a function of all that fiscal largesse. This is why we think that America essentially gave the Trump administration such an aggressive mandate to try to fix this, which is why we thought they were going to pivot us from Paradigm Alpha to Paradigm Bravo. And the problem with pivoting us to Paradigm Bravo, as we talked about a few slides ago, was the rest of the world wasn't having it. They are our creditors. A net 90% of our GDP's worth of our assets. They own a net 90% of our GDP's worth of assets. And so the Trump administration essentially not playing nice in the sandbox essentially, risked at durable loss of U.S. exceptionalism and a potential debt spiral as the dollar declines, bonds decline, interest rates go higher, the deficit blows out, rinse and repeat. And so that was the risk. And ultimately, that's why we think they've adopted this Paradigm Charlie theme. I want to say about, okay, what is Paradigm Charlie? Well, Paradigm Charlie is a situation where they were going to try to cut their way out of the U.S.'s sovereign fiscal indebtedness, obviously one of the most indebted economies in the world, particularly when you look at it relative to our domestic liquidity stock. I think we're somewhere close to 117% of our domestic liquidity in terms of our sovereign debt. That compares to about 30, 40, 50% for our peer economies like Japan, China, Eurozone, et cetera. And so we're kind of about to lunch in terms of how much debt we have and relative to our own domestic ability to capitalize that debt. And so now we're essentially in a scenario where we're going to try to outrun the debt. You and I've talked about the four-turning ad nauseum on this program. And for those who may be a little bit unfamiliar, they can definitely reference our previous interviews or some of our published research behind our paywall. But, one of the key takeaways from that, there are several key takeaways from that, the research that we performed in terms of doing the empirical deep dive on four-turning from an economic and market perspective. But one of those key determinations was that, hey, when you get to this level of sovereign indebtedness, and it's partially driven by this sort of K-shaped economy in terms of the demand for populism in the economy and ultimately response from fiscal policymakers, when you get to this level of indebtedness, you really only have three ways out as a sovereign. You can try to cut your way out, which was Paradigm Bravo, or you can try to grow your way out, which is Paradigm Charlie, and then Paradigm Delta, which is Paradigm D, will be they'll print their way out. We're ultimately headed towards they're going to try to print their way out of the mess. But in our opinion, we think we have to spend at least a couple of years in Paradigm C, Paradigm Charlie, of them trying to grow their way out of the debt. And so I think investors need to start investing with the expectation that, hey, everything you're hearing about tariffs, which are being overrepresented relative to trade share of the U.S. economy, relative to good share of U.S. consumer spending, tariffs are being overrepresented, but what's being underrepresented are all the different factors that are putting together this Paradigm C theme that's going to allow, or at least on a transitory basis, allow the U.S. economy to sort of outgrow the debt for a short period of time. They're ultimately going to fail at this, but at least you don't want to short that as an investor from this starting point.
How do we reconcile this question of the massive, massive national debt and growing deficits and so forth? The problem I have is everybody's made this argument before, and they were right when they made it before. When Ross Perot said in 1992 that the U.S. national debt was not sustainable, he was right, but it is sustainable longer than almost anybody imagines possible before it all falls apart. Then it usually falls apart faster than anybody believes possible. I keep feeling like we're closer to that moment where of sudden acceleration where, it's falling apart quickly. But how do you gauge that? How do you quantify it and really know when we're there and we're not just going through another round of let's talk and sound responsible talking about fiscal responsibility when in reality this problem has been talked about for decades and hasn't really materialized?
Yeah, that's a great question, Eric. And so I will say the way we risk managers think about market risk is a little bit different than how I would say a politician or maybe even a novice investor would think about market risk. The stock of the debt is irrelevant. As we've seen with Japan, debt can literally grow to the moon. What matters to a risk manager and what matters from a market timing perspective is the supply and demand of the debt securities. To me, that is what matters. And why this is now an acute risk, financial market risk, as opposed to a political talking point is a function of, this geopolitically driven supply demand imbalance that we identified in the treasury market a few years ago in the context of our investing during the four-turning regime framework. I'll throw a few statistics out there at you really quickly. When you think about, who owns U.S. debt, if you go to slide 88, where we show foreign creditors own about 32% total of U.S. debt. That's about $9 trillion worth of securities on its way to 10. But the problem is it's on its way to 10, not fast enough. And now we're starting to see, structural forces in the content that are all four-turning style forces that are really starting to kind of erode that former demand for U.S. Treasury securities at a time where we're actually accelerating the growth rate of those securities. So we have supply going up, demand going down at the margins. And ultimately, it's causing a rift that ultimately will require durable Fed yield curve control to fix. We're not there yet. We're not in the paradigm D delta phase of this. We're still in the paradigm C growth phase of this. But ultimately, that paradigm D print phase is coming in the coming years, in our view. You think about three structural forces that are all causing the U.S. the U.S. Treasury market to grow from a risk perspective. So number one would be the remilitarization of Europe. If you look at the NATO defense spending pledges, both in Germany, but also across all of NATO, they're trying to take NATO defense spending from 2% to 5% of GDP. Now, I'm guessing by the time we get to 2035, they're not going to be at 5% of GDP, much like many of the economies aren't at 2% now, but we know the delta is higher. And ultimately what that represents is a durable capital call home from our European creditors that now have to finance their own sovereign debt markets in terms of the expansion of the defense spending and the increase in infrastructure spending. And all this stuff requires debt that they need to now capitalize as opposed to capitalizing our own treasury bond market. So that's number one. Number two is Japan's policy normalization. One of the most under talked about risk in all of global macro is the fact that Japan has durably escaped deflation and has for several years now. And so ultimately what that means is Japan's monetary policy normalization is likely to remain ongoing for the foreseeable future. They're already guiding to it remaining ongoing for the foreseeable future if you look at the latest BOJ guidance. And then finally, number three is China's strategic decoupling from the U.S. Notice I didn't say the U.S. is strategic decoupling from China. I'm saying China is now actively accelerating its own strategic decoupling from the U.S. For example, if you look at the share of exports to the U.S. from China, it's now down at 12% from a peak of about 20, almost double that about 20 years ago. So that's a big structural force. And if you want to look at U.S. imports from China, we're now down at 7% of total from a peak of 24% back in 2015. So there's been this massive shift in terms of our three largest creditor economies in terms of the capitalized in the treasury bond market. They're now either durably need their own capital to come home, they don't need to buy treasuries at the same rate in China's case. In Europe's case, they're essentially having a capital call home. And in Japan's case, they have enough capital restriction that's going to limit the cross-currency basis that they pick up from perspective of capitalizing the U.S. Treasury market. In fact, if you subtract the cost of hedging dollars from the perspective of European and Japanese investors, you're essentially, relative to staying home in their own domestic bond markets, you're essentially losing by over 100 basis points relative to just staying home and capitalizing their own bond markets. So this is a relatively new dynamic in global financial markets that is likely to be ongoing in the context of the secular dollar bear market that we continue to call for. So, going back to where you started the question, it's not about the stock of debt or the growth of the debt or the size of the budget deficit or who's got this politicized talking point about this or that. Who cares? I could care less about that. We can talk about that stuff forever. But what matters is the supply and demand imbalance for these securities and global financial markets. And one final thing I'll say is one of the reasons this has become more of an acute risk over the past couple of years, since let's call it late 2021, is the fact that the share of price insensitive buyers in the treasury market has declined considerably, and they've been replaced by price sensitive buyers. So if you look at, the kind of the Fed's share of treasury debt, they've declined from about high 20s to 15%. If you look at a foreign central bank share of treasury debt, they declined from, let's call it 40% in 2008 to about 14% now. Commercial bank share of U.S. Treasury debt peaked at somewhere around 35% in the early 2000s. It's now only 16% now. And so the residual of that is the private non-bank sector. It's us, the investors, the investor class. We now own 56% of marketable treasury securities, and that is up 2,000 basis points since the end of 2021. And so we've replaced all these price insensitive buyers with price sensitive buyers. At the same time, this geopolitically driven supply demand imbalance in the treasury bond market is accelerating from a structural force perspective. And all these structural forces in terms of decoupling, remilitarizing, and elevated inflation in Japan's case, these are all things you should be expecting as an investor in a forward turning, and something we've been guiding our clients to anticipating for the past couple of years.
Okay, Darius, as I assimilate this whole paradigm evolution theory of yours, it seems to me like what you're saying is basically right now we're moving into paradigm C. Paradigm Charlie is entirely about grow our way out of this. Okay, you and I both know what that means is a whole lot of pro-growth policy, which is going to be bullish for financial markets. Lots of good reasons for listeners to take heed of your and Lynn Alden's advice to run their portfolios hot. But you've also described that where it's inevitably headed is toward a future, hasn't happened yet, transition from paradigm Charlie to paradigm Delta, which is where we go from grow our way out to print our way out. And I would say that economic history teaches us that is an incredibly perilous moment where you don't want to be overweight equities. You want to be very, very hedged. Therefore, I'm concluding the most important thing out of all this is what are the signs of the transition from C to D, from Charlie to Delta?
Yeah, great question. Great question. To me, I think the transition is going to come from a political standpoint. So let's really quickly touch on some of the levers that the administrations are likely to pull to try to exhaust all of the options, the available options that they have to try to help us grow our way out. So let's jump to slide 51, where we show the impact from a budget deficit standpoint of the one big ugly bill. So you can see here in this analysis from our friends at the Committee for Responsible Federal Budget, the impact of the fiscal impulse from the one big ugly bill is front loaded and the savings are backloaded. So what you're going to see is peak positive fiscal impulse over the next 2 years. In fact, you're already starting to get some positive fiscal impulse in here in terms of the retroactiveness of some of the provisions in the tax cuts or some of the provisions that were rolled over from the prior Tax Cuts and Jobs Act and some of the new provisions from the one big ugly bill, like no tax on tips and the increased deduction for seniors. So a lot of that stuff's already starting to pour in from a fiscal relief standpoint here in 2025. But the peak fiscal impulse will come over the next couple of years. So you definitely don't want to fight that as a bear. Paradigm Charlie also features the monetary largesse that we observed in Paradigm Alpha. On the third panel, we show the floor Fed funds rate that's currently at 3.25. And then the bottom panel shows the floor Fed funds rate minus the 2-year tips break-even rate. And for those who may be unfamiliar, the floor Fed funds rate is just the minimum value on the overnight index swaps curve out 2 years. And so that's essentially where the market is pricing in the Fed's policy rate to get to from a rate cutting cycle perspective over the next 2 years. And then we show that on a real basis in the bottom panel. As you can see, since the start of the year, we've essentially cut the real floor Fed funds rate by 100 basis points since the start of the year. And ultimately, by the end of this process, we think that's going to be a durably negative number. Obviously, what's making headline news today, we're recording here on July 16th, is Kevin Hassett now being the front runner for the replacing Jay Powell at the Fed. Our clients can attest to this. I laughed out loud in one of our recent Around the Horn videos, just kind of thinking about how preposterously and hilariously dovish Kevin Hassett would be as a Fed chair. And ultimately, I think that's coming to a theater near you, because forcing incremental monetary largesse upon the economy is one such way. It's a lever that the administration can and likely will pull to, try to engineer an economic boom, however fleeting it may be. If you look at slide 53, deregulation is a big lever that they can and will pull, particularly financial sector deregulation. Don't forget, they put this man, Paul Atkins, back at the top of the SEC. Paul Atkins was the guy who was running the SEC when Chuck Prince said, you got to keep dancing with the music's playing. Paul Atkins was the DJ playing the music ahead of the housing crisis, the financial crisis, the global financial crisis. And so they put this man back atop the SEC. And so we know the music's going to get turned on from a financial sector deregulation standpoint. We've already seen elements of this. They're going to relax the supplementary leverage ratio by the end of the year by, let's call it 150 basis points. They've already neutered the Consumer Financial Protection Bureau. Wells Fargo, which effectively committed a crime in December, was let out of the penalty box weeks later when the Trump administration took office. And so we're already seeing evidence of financial sector deregulation, and it's already starting to show up in credit growth. We had, if you look at the top panel in this chart on slide 53, commercial bank loans and leases are now compounding at 6.6% on a 3-month annualized basis. It's the first time, and have been for the past, roughly in that range for the past month and a half. It's almost 3 months. This last 3 months of credit growth is the fastest 3 months of credit growth we've seen since the first quarter of 2023, just prior to the regional banking crisis. So we're now kind of coming out of, what had been a very depressed period of credit growth for the United States. So we now have this upside risk to the business cycle that's a function of levering up the private sector balance sheet, which has been very delevered since it started to delever, back in 2008. Paradigm C also features some reshoring your critical industries, as we show here on slide 54. Construction spending, particularly non-residential and residential, which are the second and third panels in this chart. Non-residential construction spending is currently compounding at minus 2.5% on a 3-month annualized basis. It's not going to stay down there if they're going to reshore at all, right? Like they're going to reshore. Like we have, like $10 trillion of capital commitments, at least secured capital commitments from President Trump and everyone that's kissed the ring in the last 6 months. Now, we know that's all fake and phony fluff, but at some point, some of that dollars are going to start to build some factories here in the U.S. So we know this number is going to go up. We know that they're targeting a recovery in the housing market explicitly. Scott Besson has confirmed this. So housing, residential construction, which is compounding at minus 8.5% on a 3-month annualized basis, that's not going to stay negative either. So you have credit growth that is now accelerating to an above trend rate, the building of factories and structures that are likely to accelerate. You also have the acceleration in residential construction. That's probably going to be a function of deregulating the housing sector. You also have AI, the continued infrastructure investment associated with AI, both on data center build out and powering those data centers. So you have a lot of levers that are going to get pulled, both by the administration, also by the private sector over the next, let's call it 1 to 2, perhaps even 3 to 4 years, in terms of trying to grow our way out of this debt problem. Again, it's not going to work, but they're going to continually, increasingly pull those levers and try to get it to work. And one of those levers, and I'll shut up, one of those levers that they're going to pull, in our opinion, is ultimately, maintaining this very dovish net financing policy that we've seen, out of the Treasury. So if you skip to slide 56, what we're showing this chart is the weighted average maturity of total marketable Treasury debt. It's about 6 years. And then we show that the second, third, and fourth panels is the percentage of marketable Treasury debt maturing in the next year, the next 2 years, and the next 3 years. If you look at the percentage of marketable Treasury debt maturing in the next 12 months, so you can assume those are mostly T-bills, that's about 31%. It peaked at 48% in the early 1980s. So we think that number is going to be on a structural rise because there's going to be no tolerance for issuing and taking down a tremendous amount of bonds in an economy that's being ran hot from a fiscal and monetary largesse perspective. There's also going to be not a lot of demand for bonds in the context of replacing a bunch of price insensitive buyers with a bunch of price sensitive buyers in the Treasury market. And there's ultimately not going to be a lot of demand for bonds as a function of that geopolitically driven supply demand imbalance that we identified years ago in terms of Europe's remilitarization, Japan's policy normalization, and China's strategic decoupling. So they're going to jam us with a lot of T-bills. And one of the reasons we know that the administration, and going back to our second or first question, Eric, one thing that gives us a tremendous amount of confidence in our paradigm Charlie view and the durability and ultimate upside risk to both the economy and asset markets over the long term is the fact that Treasury Secretary Scott Besson, whom I've known for years, former client, he spent almost 18 months just lambasting our fellow Janet Yellen's dovish net financing policy in terms of her, concentrating issuance in the bill market. Second he got into the seat, he said, "Oh, no, wait, I think I'm going to keep this policy." And as most recently as a couple of weeks ago, he was on Face the Nation, essentially saying, no, this is, the time to term out our debt had passed already. And so ultimately, in our opinion, that was a very clear signal that in this paradigm C, try to outrun the growth of the deficit and try to grow your way out of this fiscal malaise, this sovereign indebtedness. They're very unwilling to upset the apple cart, to copy and paste policy that you spent the previous 12 to 18 months just, criticizing and ridiculing, in our opinion, is a very clear signal that these guys don't want to do anything to dramatically upset the apple cart. So investors should be taking that as a clear signal. Ignore President Trump's ridiculous trade tariff tweets. Just understand that their ultimate goal is to boom the economy. And if they are successful with that, and they likely will be successful with that on a transitory basis, let's call it 1 to 2, perhaps 3 to 4 years. If they're successful at that, consensus is not positioned for that. I don't even think consensus understands half of that in terms of the myopic focus on tariffs when I look at the media. But the reality is, Paradigm C is here to stay in our view, and ultimately that represents a tremendous amount of upside risk in asset markets from the perspective of risk assets.
Darius, I want to go a little bit deeper on the Fed, both because you brought that up and because it's super relevant. All the things you're talking about, it's going to be the Fed's policy making that's going to decide a lot of these things. Okay, hang on a second. We're dealing now really with completely new territory. Does the President of the United States have the authority to fire the head of the Federal Reserve, an organization which is theoretically not even part of the government and which was created specifically to be independent from the government so that the president would not be able to interfere with monetary policy? It's clearly an affront to that. So everybody's talking about who the person would be. It seems to me that the more important question is, are we likely through the political process to allow this apparent fait accompli that the president has the authority to fire the Fed chair?
That's an excellent question, Eric. And I really think you have to, one, believe in the foreturning, and two, understand the implications of a foreturning upon the economy and asset markets, as our clients do here at 42 Macro, to really have what I would consider to be a satisfactory answer to that question. So at face value, no, this is just one of many presidents in the last 100 plus years that have jawboned the Fed and have taken great criticism to the acting Fed chair. But the reality is we are in a fourth turning. And what happens in fourth turnings is the distribution of probable policy outcomes widens tremendously as a function of the, among other things, social discontent and political volatility. So we have someone who believed he survived an assassin's bullet to usher in a new paradigm for a new regime for how the U.S. economy works and how it functions on the global scale. And so ultimately, you have a man who has very clearly proven he has, a limited amount of respect for the established rule of law. He has a tremendous amount of respect for his own rules of law. And ultimately, we are probably going to see some form of political and or congressional influence, and if not legislated, that could potentially change how the Fed operates. I mean, you have Kevin Hassett essentially rubber stamping everything Donald Trump is saying with respect to Fed policy. And then you have Kevin Warsh, who's essentially, switched up from being a complete hawk because he wants the job. A couple months ago, he was very hawkish, and now he's very dovish. He's calling for a complete overhaul of the institution in terms of, cleaning house, all the PhD economists that work there, cleaning house with the Fed board or Fed governor board. I mean, this is fourth turning style stuff. You have to understand that in a fourth turning, the distribution of probable policy, economic, and market outcomes is significantly wider than it is when you're not in a fourth turning. And so all those structural forces that are ripping and pulling the economy and policy and society apart at the seams, the Fed is not separate and independent from that. The Fed is also part of that. And so ultimately we expect, some material change to how the Fed operates in the coming years as a function of these fourth turning type policy dynamics. So if you look at slide 57, in this chart, we show, top panel shows December 25 Fed funds futures yield, 10-year nominal treasury yield, the 10-year US dollar index. The second panel shows the blue line is the December 26 Fed funds futures yield. And then the bottom panel is the OIS derived Fed funds rate out 5 years. You can see that there's been a big divergence between the dollar and short rate and long rate pricing in the past few months. And so in our opinion, we think the currency markets are already starting to sniff out the fact that the Fed may, its independence and or how it operates from a dollar credibility or inflation fighting credibility standpoint is going to get challenged, perhaps aggressively in the coming years. And so ultimately, we think as investors, you have to take the under or take the over on rate cuts, take the under on the level, the terminal of the floor Fed funds rate. We show that on slide 69, where in the second panel, the Fed's dot plot, which was hawkishly revised in the most recent SEP, Summary of Economic Projections, now is only forecasting one rate cut in 2026. This is after them projecting 2 rate cuts here in 2025. And that's wrong in our opinion. In our opinion, I think by the end of 2026, you got to assume there's likely to be double that from a policy rate cutting perspective. And so ultimately, we think the markets are starting to sniff that out. If you look at what the Fed fund futures are pricing, they're essentially pricing 2.5 rate cuts next year as opposed to only 1. And that's a big change from where we were a few months ago. And so we think the market is starting to come around to our view that whatever you think about Fed policy and the durability of the legacy institutions regarding the Fed and in and around the Fed, you have to assume that they're going to get changed. Fourth turnings are where institutions go to die. Fed independence can die in this fourth turning. The Fed itself could die in this fourth turning. Heck, the country, the United States of America can die in this fourth turning. That's how big the stakes are. And for anyone who thinks I sound heretical about that, go back and read my former colleague and one of my mentors, Neil Howe's 2 books on this subject matter, and then review our Investing During a Fourth Turning Regime analysis presentation. If you consume those 3 materials and still think I sound heretical, that's on you.
Okay, Darius, but I just want to pull this together and get a sense of the timing and how we navigate this future that you're describing. Because what I'm hearing you say is we should expect a fantastically bullish market environment as a result of a whole bunch of grow our way out of a problem that can't be grown out of kind of policies until they figure out that it can't be grown out of, at which point it turns into a print your way out situation, which is probably also a market crash situation. So it's fabulously bullish until the shit hits the fan, and then it's really ugly, if I'm hearing you correctly. What's the timing? Are we talking years, months, quarters? I mean, there's a pivot there some point where you want to go from max long to max short. Is that quarters away, years away?
From a fundamental standpoint, I think we have at least until November of 2026 on this paradigm C theme. Beyond that, it's hard to forecast because we may get some adverse outcomes from an election standpoint that sort of limit what the administration can continue to do to kind of pump the economy from a fiscal largesse perspective. So that, I think it's TBD, but I think we have at least until the midterm elections and perhaps even beyond that in terms of the persistency of fiscal largesse and perhaps the deepening of monetary largesse. So in our opinion, I think it's TBD. But the most important thing I would say, just take away, is if you go to slide 157, and we can end on this, 157 and 158, one of the key takeaways from our investing during a forward-turning regime analysis is that asset markets tend to appreciate faster in a forward-turning regime than they do in first, second, and third turnings. We found that was a statistical finding that we determined, but they depreciate faster with more volatility. So they have they have high, the bigger up moves, but also bigger down moves, and also the frequency of the market cycles themselves actually speeds up. And isn't that exactly what we've experienced in the past, let's call it decade or so? Every year since 2015, we've had a intra-year crash of 20% in absolute terms. The market has either gone up 20% intra-year or gone down 20% intra-year every year in the past 10 years. I mean, that's insane. And that's exactly what we would have forecast. That's exactly what we did forecast. Continuation of going back when we introduced that analysis. And so I think I would have to have an unusual amount of hubris to tell you exactly when Paradigm C is going to end. Given that we're only a few months in, I think I reserve the right to do my job as an institutional macro risk manager for our clients over the next it's called 1, 2, 3 years and try to determine that. And so that's why I'll end on slide 158. You don't have to live in fear of not knowing when Paradigm C is going to end. You don't have to live in fear of not knowing when the thing that causes Paradigm C to end, that will be very painful for most investors, they'll ultimately require the ushering in a Paradigm D. You don't have to live in fear of that. You can just dispassionately execute our KISS and Dr. Mo signals along the way, which keep you on the right side of market risk. I don't have to forecast when that occurs. I just have to refresh the model on the day that it's starting to occur, send a signal to our clients and say, hey, take down risk. We're about to go into the valley between Paradigm C and Paradigm D. And ultimately, those same exact signals will help our clients come out of the valley and buy the lows and really position themselves for Paradigm D. And so I don't know when that's going to happen, but I know exactly what I'll be doing between now and then and throughout. It's the same exact thing that I do every single day, 6 days a week for our clients here at 42 Macro.
Well, I'm not going to stop on page 158. You'll like where I'm going next, though, which is slides 9 through 11. For many of our listeners who are very well familiar with your approach, I asked Darius not to go through the process they use at 42 Macro in full detail on every one of these interviews because it would be too much, and a lot of us have heard it before. But for any new listeners, you're definitely going to want to check out this process. This is a very... what would I describe it as? A very methodical and systematic approach to macro. Darius, very briefly, give the quick overview of what you do at 42 Macro, what is in that 9 through 11, and for people who want the full version of it, how do they contact you to find out more about what you offer?
We are systematic investors here at 42 Macro. I know we spent most of this conversation talking about our fundamental research views because that seems to get the audience's attention, but the reality is we don't use any of our fundamental research, which I think is some of the best in the world. Many of our institutional clients agree. We don't use any of that fundamental research to manage risk in financial markets. We use our KISS portfolio construction process for retail investors, and we take those same exact volatility targeting and dynamic position sizing signals and push those to institutional investors via our discretionary risk management overlay, aka Dr. Mo. That's on slide 12. And so you can sort of quickly see on slide 10, sort of the summary statistics of what it feels like to be an investor participating in our KISS system. It's a very simple system. You're either long stocks, gold, Bitcoin, or cash at any given time. And what we ultimately found out is that based on our forward-turning regime analysis, based on our fundamental research, and ultimately based on the market signals that we've accumulated throughout the years, stocks, gold, and Bitcoin are the 3 best asset classes to take advantage of the types of policy responses that we tend to see in forward turnings. So I highly recommend investors check that out. Review the summary statistics on slide 10. I'd say the highlight is you essentially it's a 250% upside capture ratio relative to 60-40 with only a 50% downside capture ratio. So I can't think of a better solution to help retail clients, retail investors retire on time and comfortably. You can see the output of our current KISS allocations on slide 11. We're currently fully invested and have been for a while. KISS started buying back gold, KISS came into the year max long gold. And obviously that's been a great call, or not great call. It's not great call by me, great call by the system. Bitcoin has started buying back Bitcoin in mid-April and started buying stocks back in late April. So, we've captured a tremendous amount of the upside. We've seen since the lows of April, much more so than I would say the average investor. And this is coming off of KISS having effectively risk managed the crash that we fundamentally called for coming into this year. So really proud of the system, really proud of our clients for partnering with us for engineering better results in their portfolios that they may otherwise have without us. So, Eric, I just want to say thank you for having me on the show. You're doing a great service for the world, my friend. I've learned a tremendous amount from you and your guests that you featured on the show over the past decade plus. And I'm just really grateful and humbled to be a contributor.
It's always a pleasure to have you on, my friend. Patrick Serezna and I will be back as Macro Voices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Serezna.
Eric, it was great to have Darius back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Darius's picture saying, looking for the downloads. Okay, Eric, what are your thoughts here on the equity markets?
Well, Patrick, I'm generally persuaded by Darius's bullish arguments, which I think echo Lynn Alden's bullish arguments, which I was persuaded by last week. Now, my whole rationale for over-hedging left tail risk has been that it's clear to me that Trump and Bessent are willing to disregard financial market consequences of their policy actions, and I think they've got plenty more policy actions planned. But the more I get a sense of what the next round of policy actions might be, the more I agree that they're more likely to be stimulative in near-term bullish equities. Now, I'm still going to hold a left tail hedge here, but maybe if we get a nice dip here that puts my position back in the money, I'll be able to, reduce that to maybe take half the position off because I'm not feeling the conviction or need for that left hedge tail in size that I have it as I was when I put it on. But I do still think that there's reason to have it because I don't think we know and what's going to come next, and I am certain that Trump and Bessent are not afraid to break things in order to accomplish what they want to accomplish, whatever that might be.
So let's just talk about this purely from a technical perspective, Eric. We have a market that has had an extraordinary 3-month run, trading at its 52-week highs, trading close to 300 S&P points above its 50-day moving average, completely overbought. Yet at the same time, structural flows are still in the favor of the bulls, with close to $100 billion of buying still on the table from systematic vol targeting funds, at least according to a number of prominent quants out there that are calculating those numbers. And so the primary trend is clearly higher. We've also made a 52-week highs. So the primary trend is quite intact and arguably can still extend to 64 to 6,600 on the upside. But inevitably, after 3-month bull runs, almost always comes some sort of a 5+% market correction. And the question really becomes, when will inevitably one appear? And should one even do something about a 5% correction? Because even if we returned back to the 50-day moving average with a 300-point correction, odds are very good that it will be bought on dip on the first test. And so if it then subsequently a few weeks later rallies right back up to the highs, how much market timing and hedging was actually required during that? The bigger question to ask is when all of the structural buying finishes, when we get past all of this, are we going to be in a situation where this market has gone too far too quickly and some sort of natural mean reverting correction gets underway? We can only speculate on that, and more importantly, it's likely not going to be a short-term risk. If it is, it's a latter part of the summer into the typical late August, September window, which typically has a lot of weak flows into the market. Nonetheless, on the short term, we're in this tight trade range driven by some gamma pinning from option expiration. Quiet in here. There's definitely room for volatility to return when we get deeper into the earnings season. But at this stage, nothing really a big risk in my mind beyond at some point a very typical pause and 5% correction that happens all the time in the markets. All right, Eric, let's move on to that US dollar.
Tuesday and Wednesday's strong finishes on the Dixie could be the beginning of a counter-trend rally. Now, the market had already rallied quite a bit in the last few days, but that was within the established short-term price channel. These last two closes over the Tuesday and Wednesday close broke the upper trend line, suggesting a more sustained counter-trend move higher might be starting. I remain committed to my bearish fundamental view. 89 is my target longer term on the downside for the U.S. dollar, for the Dixie. But I also remain committed to the wisdom that markets never move in a straight line, and this one is overdue for a counter-trend surprise. I don't know when it's coming, but I'm sure it's coming sooner or later. So the bottom line is watch the Dixie closely for a possible short to medium term counter-trend move. Maybe it's already started, or maybe it's going to fail here. But if it does and we're back down to 96 tomorrow, still keep your eye on this market. I think we're going to get that counter-trend rally, if not on this swing, maybe on one of the next two swings lower. We'll get it at some point, and don't get caught off sides by it. But I'm still committed to it's a counter-trend rally. We're headed lower. Ultimately, I think low 90s, if not high 80s on the Dixie.
Well, my view on the U.S. dollar remains that it is the most consensus short. Everybody out there is bearish the U.S. dollar, and arguably, if you're projecting out 1 or 2 year forecast, certainly the argument that the U.S. dollar could be lower is valid. But on the very short term, after the dollar index went from pretty much the 110 level all the way down to 97, a 13-point swing, inevitably there's going to be a mean reversion, and more importantly, the potential of a short squeeze. When so many traders are in consensus and are all crowded in the same trade, sometimes the counter trend reactions are purely driven by flows and don't even have to have a fundamental reason behind them. The question here, as we approach this 50-day moving average, have we seen this as a pivot area for the dollar, or is this going to reject here at the 50-day moving average and still stay in a primary downtrend? This is the puzzle that we'll be trying to solve here in the next few weeks. The dollar has not really yet shown its hand. What I do, though, want to highlight is that on page 4, I have the chart of the US dollar yen. And what's interesting is this is the first currency pair that is really starting to show that the US dollar has bottomed out and potentially reversing. Not only did we see the low for the US dollar yen back in April, but it's consolidated sideways with a definitive bull breakout here. And so is the US dollar yen really starting to show that something is pivoting and that some sort of US dollar buy cycle may be underway? Let's watch whether other currency pairs start to show these types of characteristics. All right, Eric, let's move on and touch on crude oil here.
Patrick, my directional conviction was weak last week, and it's even weaker this week. My second chance trade has given up most of its profits since we put it on. I didn't actually put it on, since I described it on the podcast a couple of weeks ago. At this point, having given up most of those profits, I would sooner exit than double down on that trade here. I don't have any directional position on in this market. However, I still do have my long on Z5 M6 calendar spreads, as I've described previously.
Well, Eric, my view on crude oil is a little more neutral to bullishly biased in that I don't assign a high probability of crude oil going for a double bottom retest of the lows that it established back in April and May down in the mid to high 50s. At this stage, I think that there's a new structural higher level of crude that will probably stay at the lower range in these mid 60s and an upper range in the mid 70s. And so when we look at the potential trade range that might be established, much like the trade ranges that were established last year in September through March of this year, there's this range of new higher elevated oil prices from where those very bearish lows were established just a few months ago. Overall, though, that doesn't necessarily mean that there's a huge upside for crude oil immediately. I think there's a lot of fundamental things that would have to go in the favor of crude for us to have a stronger run. It's just, I think that the new higher level of crude makes sense, and that certainly could drive some short-term flows continuing into many of these equities. All right, Eric, let's touch on page 6, the chart of gold. It's been in this sideways consolidation for a prolonged period. What are your thoughts here?
Now, we're still consolidating sideways, and in terms of stochastics and converging trend lines and so forth, the short-term symmetric triangle pattern that we've seen here should see some kind of resolution, hopefully within the next week or two at the most, and we'll know where this market is headed. I'm definitely still leaning towards an upside resolution to that triangle pattern, but exactly when that happens or how it happens, who knows? We would need to see a daily close over 3463 or below 3285, 3285 in order to know for sure. Now that's a $180 window. That's a pretty wide margin. So there's still time for plenty of ups and downs here before we know the resolution of this triangle pattern for sure. But what we do know for sure is that we're already close to that lower trend line. So if your bias is bullish, as mine is, 3,300 is still a buy here. I wouldn't be adding there because, I just added there the last time we hit it a week ago, and I'm already at my target position size. But if I was looking to add more at this point, I'd put my limit order just above that 3,300 round.
Well, when you look at this chart, it really does continue to look like one big horizontal triangle formation. And we've now seen this multi-month consolidation. Now, this happened 3 times before on this chart. So if you go back through November of 2023 to February, where we had this extended sideways range, or April of 2024 through to July, where it was incredibly tight sideways range, or you take November of 2024 going into January of 2025, again, another 3-month sideways consolidation. Each time one of those consolidations happened, they ultimately bullishly resolved itself. At this moment, the puzzle to solve is that will that pattern persist? Support along its 50-day moving average, takes a break to unwind its overbought state, and then turns around and has a bull continuation. This is definitely supported by the fact that we have seen some very bullish price action in platinum, palladium, and silver continues to do very well. So the broader precious metals market continues to take flows, and it's very likely that gold is going to maintain some sort of a bullish bias here. Now, even if we saw gold go through a typical kind of 5 to 10% correction, where even, let's say, returned back to 3,000 temporarily, that would just be an extraordinary buying opportunity. I don't at this moment anticipate that 3,000 test, but we are right at the 50-day moving average, which is going to be a very good arbiter of trend. And if we see breakdowns of gold below 3,300, that could mean some deeper correction is underway. But at this stage, I'm maintaining a bullish bias here on gold. Now, Eric, on page 7, I have that Sprott Physical Uranium Trust. And uranium has been such a strong spot in the markets. And now at least the uranium prices have come off. Many of uranium equities continue to hold up along 52-week highs. How do you size this up?
Well, Patrick, as our regular listeners know, I have lots of company in the uranium investing community of other investors hoping, praying, begging for a meaningful correction or pullback that would allow us to add more to our positions at a more desirable location. My fears are being confirmed. I'm afraid that teensy weensy itsy bitsy little correction, you want to call it a correction, let's call it a hiccup, that we just had of about 5 or 6% or so that we pulled back on uranium stocks. I'm afraid that might have been it. That might have been our summer consolidation pullback, your chance to buy the dip. I did buy that, by the way. I've already bought that dip, but I was hoping to buy much more on a much larger dip. I'm continuing to scale in gradually, waiting for that meaningful dip to get aggressive, but continuing to scale in. For me, though, this is only about putting that last 20% of my target position size on. I did most of my buying on the way down, and I bought very aggressively in April around the bottom. So I'm just adding icing to the cake at this point. If I had no allocation allocation to uranium. I would definitely not wait here. I think we're probably already just starting a rally that's going to take off and run. The break on the URA ETF closed Wednesday above $40 for the first time ever, probably, or certainly in recent memory. I think we're probably off to the races here. So if you don't have any exposure to this market, I'd be thinking about immediately putting half of your money to work, then, hoping along with the rest of us for some kind of meaningful pullback to buy the dip on. But I think there's a good chance we just don't see any big meaningful dips.
Well, technically for me, this is actually a critical moment. So we had this, 12 to 14 month bear market in uranium prices. And this rally that we saw over the last 3 months really has shown the characteristics of pivoting the trend back in favor of the bulls. But the real test always in a bull breakout is whether dips start getting bought and we see the pattern of higher highs and higher lows. And so this pullback here in the spot physical uranium to a typical retracement zone and back to its 50-day moving average is going to be the big tell. We're going to find out whether, in fact, we've transitioned into a new bull cycle and whether the buy on dip traders genuinely do buy the dip here. So we'll watch and see how that continues to develop. Now on page 8, we have that copper chart. Now key here is that we're looking at the COMEX copper because obviously the LME copper prices have not moved. This is clearly a tariff-driven move. Well, what's your take here, though?
Well, Patrick, I'm impressed that copper is holding up here, pretty much holding at the same level it was at 2 or 3 hours after the tariff announcement came out. It's impressive to me that it's holding that strong because I think the many people in the media who have seen through this 50% tariff idea and recognized that the president would never impose a 50% across-the-board tariff on a raw material like copper that U.S. businesses urgently need. Obviously, he's bluffing. This is a negotiation or something. It's not really going to happen. So the big move up that was an obvious reaction to that announcement, it seems like it ought to retrace. It's still a ripe short, but I'm still going to pass on it because I'm so bullish copper longer term that I don't want to lose my position trying to get cute and trade in and out of what's intended to be a long-term hold position.
Well, my take here is that irrespective of whether or not it's impressive that they've held the price up at this level, the bigger question is there more money to be made being in copper? To me, the tariffs have now been priced in. This thing is already ripped with a big premium in it. And so to me, the asymmetry of being long or taking a brand new long position in copper prices here doesn't make a whole lot of sense. And you have the vulnerability that suddenly a new adjustment to that tariff comes out in an announcement and suddenly all of this premium gets pulled out. To me, I remain very neutral here and don't see any high conviction call on copper moving forward.
And Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Well, Eric, on the 10-year, it looks like it's gravitating back towards the top end of its ranges, and this is much more evident on the longer duration bonds like the 30-year, which have already tested the 5% mark. Bonds continue to be a stress point, and while not many people are talking about it, I continue to think that if we were to have a risk event, it would be based on the bond vigilantes coming out here and voting with their money on pushing yields higher on the long end and creating a bear steepener. Will this prevail, and will that be what ultimately spooks the market? We'll see. Now, what's interesting is the 10-year is far more important for benchmarking interest rates, mortgages, and other things like this. That hasn't moved as much, but will a move in the long bonds kind of spill over, causing the 10-year to react? And that's certainly the thing I'm keeping an eye on. The final thing I wanted to just talk about on page 10 is Bitcoin. And normally we don't talk about it, but this was a very clear and distinct bull breakout out of a sideways consolidation that through May and June. This is measuring out a move all the way to 130 to 135,000. It's a very clear bull breakout and has room to go. So let's see whether or not the bulls can finish off the move to that upper target.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the chart book we just discussed here in the Postgame, including a number of links to articles that we found interesting. So you're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.